call. I'm Naveen. A small disclaimer before we begin this call. On this call, our discussion will include certain forward-looking statements which are predictions, projections, or other estimates about future events. These estimates reflect management's current expectations of the future performance of the company. Please note that these estimates involve several risks and uncertainties that could cause our actual results to differ materially from what is expressed or implied. I would now request Kedar to walk us through the financials for the quarter.
Thank you, Naveen, and good evening to all of you. Welcome to our earnings call for the third quarter of fiscal 2018. I hope you had received the investor presentation that we have posted on our website. I'll now take you through some of the key themes which are emerging from our financials of this quarter. Firstly, on the revenue trajectory, the results of the quarter you may have seen demonstrate very strong momentum across our businesses in India, South Africa, API, Europe and Sub-Saharan Africa markets. On the core margins and the quality of earnings, this quarter they reflect improved mix and continued focus on the cost optimization. During this quarter, our core margins expanded by about 230 basis points on a year-on-year basis, associated with gross margin expansion and very consistent year-on-year decline across employee and other expenses. Thirdly, on the balance sheet health side, it's been improving consistently. Our efforts have benefited in keeping working capital investments under check and the tapering down of capital expenditure. As a result, the free cash flows are strong and have increased by about 56% sequentially and 29% on a year-on-year basis. The net debt to equity ratio has improved to 0.13 as at December from 0.20 as at March 2017. Net debt to EBITDA also declined from 0.92 at the beginning of the quarter to about 0.68 at the end of this quarter. Fourthly, on the tax side, you need to consider a couple of adjustments which I'll explain in the balance of the call to get to the effective tax rate for the year, which is in line with what we have communicated, which is about 25%. Overall income from the operation stands at about 3,914 crores, which indicate year-on-year growth of 7%. If you adjust it for the impact of GST classification, the normalized overall company level revenue growth is about 10%. Gross margin after material cost is about 65%. It improved about 300 basis points sequentially in line with the comments that we made in the last quarter call. This was on the expected lines and is a result of better geography mix and product mix at the overall company level. As is usual to see in the quarter four, the next quarter ending March 2018, considering the seasonality and the geography mix, we are likely to see some moderation in the gross margins. During the quarter, we also maintained strong control on the spends with total expenses, which include employee cost and all other expenses at about 1,717 crores. The decline marginally on a sequential basis. Employee cost for the quarter stood at about 657 crore. The other expenses for this quarter, which include R&D, regulatory, quality, manufacturing and sales promotion expenses, they were about 1,059 crores. They declined marginally on a sequential basis. Total R&D investments for this quarter are 7.6% of revenues. They are up as we're targeting by about 150 basis points. The increase was driven by clinical trial charges among others. With all this, the reported EBITDA for the quarter is about 819 crores or 20.9% of revenue. This is an increase of about 21% on a year-on-year basis. You would notice an increase in the depreciation and amortization line, which is on account of a drop in the value of our acquired intangible asset for the US generics market due to the evolving pricing environment and delay in launching some of the products. The overall impact of this net of tax is about $27 million. Tax charge for the quarter is negative due to the fact that the deferred tax balances for US business have been suitably adjusted to give effect to the applicable tax rates in the US post the tax reform. The full year ETR adjusted for this one-offs continues to be around 25%. The reported profit after tax is about 401 crore, which is 10.2% of sales. As mentioned earlier, if you adjust the PAT for the quarter because of the one-offs related to change in tax rate as well as the impairment of intangibles, the YOY growth is about 25%. Free cash flow after capex for the quarter is about 482 crores. In this quarter, we have invested 142 crore on the capital expenditure, which is lower compared to our historical trend and in line with our overall intent of tapering down the capital expenditure. Our long-term debt remains at $550 million, which was mainly used to fund the Invagen acquisition. We also have working capital loan of about $107 million, which act as natural hedge towards our receivables. Outstanding forward contract as a hedge for receivables as of December 2017 is $61 million and South African Rand 750 million. During the quarter, we have also hedged a certain portion of our forecasted export revenues, and the outstanding forward contracts as cash flow hedge as of 31st December is $56 million and Rand 125 million. With this, now I would request to invite Umang to present the business and operational performance. He's joining from another location over phone line.
Thank
Umang,
you.
Yeah.
Thank you, Kedar. We are progressing quite well on our key priorities for the year. Our key markets continue to deliver strong growth. India business delivered an exceptional growth during the quarter of 22% when adjusted for GST, with both prescription and generic businesses delivering healthy growth. South Africa, API, Europe, and sub-Saharan markets continued the strong momentum. This quarter, we saw the approval and launch of our much-awaited limited competition products, budesonide and decitabine. We also launched Sevlamer. However, the pricing in the market has not resulted in a sales uptick so far. We have contracted a fair share in these products already and will see ramp up in coming quarters. You would have also seen our announcement of the approval of tenofovir disproxil fumarate, which is generic for Viread. We are targeting to maintain the launch trajectory in the US with a good mix of differentiated products. We remain committed towards establishing a regulated market respiratory franchise and have achieved significant milestones during the quarter in this journey. Happy to share that on generic Advair, we have commenced trials and will soon be dosing in patients. We are also targeting initiation of 2 more clinical trials for the US in the coming quarters. In Europe, we have expanded our respiratory franchise with the approval of beclomethasone in UK. We will be the first generic player in the market. We expect to file over 10 products in quarter 4 with the US FDA, taking our financial year filing count to over 20 ANDAs. Our manufacturing and R&D sites remain in a state of compliance and control. For the quarterly performance of the total revenue of 3,914 crores, 42% was contributed by the domestic business and 56% by the international business, and the rest was operating income. I will now take you through our business performance, starting with our India business. We had a very strong quarter with the overall business growing at 15% year-on-year on a reported basis and 22% when adjusted for GST. Going forward, the growth may get moderated marginally as we saw some element of inventory build-up during the quarter, taking our overall inventory days to a normalized level now. During the quarter, Cipla outperformed the market with 12% versus a market growth of 10%, and increased market share by 10 basis points to 5.3% as per the IMS in Q3 FY18. Key TAs delivered above market performance, including our cardiac segment, which grew at 12% versus a market of 7%, anti-infectives, which grew 14% versus 11%, and respiratory, which grew 14% versus the market at 12%. Derma also grew higher than market. As you're aware, we have been focusing on leveraging our commercial strength to partner with various MNCs. In the 9-month period so far, we have already launched 6 in-licensed products. Our North America business had sales of 100 million and moderately lower than what we had expected. Current quarter's numbers do not factor much contribution from the recent launches, as those are in the process of getting ramped up. Our contracted shares look healthy, and we are excited to build a stronger trajectory in the coming quarters. Having said that, we are taking a deeper look into a marketed portfolio at the margin level and the relative burden on our manufacturing and supply chain infrastructure to see whether we need to intervene and rationalize a few of our selling products. The idea is to build a US business with a healthy profitability profile. Coming to the market performance, as per IMS MAT December 17, Cipla is the market leader in 13 out of the 48 marketed products. We are in the top 3 position for 65% of our portfolio. Cipla has been consistently ranked among the top 10 most dispensed generic companies in the US. During the quarter, we filed 2 new products and are on target to file over 20 ANDAs in the financial year. As of December 17, we have a total of 94 ANDAs pending for final approval, including 27 with tentative approvals. Of these 98, 68 are Cipla Invagen ANDAs, 11 are partnered, and 15 are filed under PEPFAR. The SAGA region, which includes South Africa, Sub-Saharan Africa, and Cipla Global Access businesses, recorded growth of 11% for Q3 on a year-on-year basis when reported in US dollars, impacted favorably by the strengthening of the ZAR USD versus last year. Our South Africa business delivered yet another record quarter of highest ever quarterly sales of Rand 1.09 billion, which translates into a 7% growth for quarter 3 versus last year. As per IMS MAT December 17, Cipla grew ahead of the market at 11.1% in the private market versus 10.3% market growth, and maintained its position as the 4th largest pharmaceutical company and 3rd position when tender businesses are included. Our partnering efforts saw a significant boost in business development agenda with the Anmarte acquisition and a deal with Innova leading to new launches in the South Africa market. During the quarter, we also concluded a deal with Adcock Ingram to commercialize their comprehensive over-the-counter portfolio in Uganda and expand their footprint in sub-Saharan Africa. Our global access business degrew 13% over last year during the quarter due to tender phasing and challenges in the funding environment. We are increasingly focusing on increasing the access to affordable care in various parts of Africa through global access and our Ugandan subsidiary. QCIL, which is a Uganda subsidiary, recorded a growth of 59% year-on-year and had its highest ever quarterly sales in quarter 3, driven by strong tender deliveries. Our Europe business continues to show strong performance with quarterly sales up 19% year-on-year basis. We are expanding our respiratory franchise and we received approval for beclomethasone as we mentioned earlier. We are on track to launch the product through our own front end and will be the first generic player in the market. In emerging markets outside Africa, quarterly sales degrew marginally on a year-to-year basis in dollar terms. The quarter was challenging given the geopolitical uncertainties in several Middle Eastern markets. On the upside, we continue to gain traction on the FPSM launch in Australia and are looking to increase our market share in the coming financial year. We are working on strengthening our business development efforts across these markets to drive future growth. On our R&D investments are focused towards building a strong growth platform for the US. Amongst the top 50 R&D projects, we are working on 16 Para IV filings in the area of respiratory, oncology, and dermatology. These also include 15 plus limited competition opportunities. As alluded to in our earlier calls, we are committed to building a strong specialty portfolio for US. We at this stage are sharing details only about our phase 1 tizanidine patch, and that is progressing smoothly. We are evaluating multiple assets with some in advanced stages of discussion in neurology and respiratory. I would like to thank you for your attention and will request the moderator to open the session for Q&A.
Sure, thank you very much. We will now begin with the question and answer session. Participants who wish to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Manoj Garg from Helco. Please go ahead.
Hi, Umang. Hi, Kedar.
Hi, Manoj.
I have 2 sets of questions. First, on the general trajectory of the U.S. business, and then secondly, a little bit more specifically on your generic Advair R&D. So first, in terms of the U.S. business, the business has been stable for several quarters here at an approximate run rate of about 100 million, which is relatively impressive in itself. But just given the number of ANDAs that you have pending, since we don't get a lot of visibility into the specific products, what's the magnitude that you think the U.S. business can grow to over the next couple of years? And then a follow on there, Kedar, last quarter, I think you mentioned that that given the margins of that business, that it's not yet, given the gross margins on that business, that it's not yet able to cover the R&D expense. How large would that, how large does the U.S. business need to grow to at current margins, to be able to do that? And then I'll just ask the generic Advair question as well. So on generic Advair, what's the general timeline that we should assume where you would be ready to file? And I'm sure you're obviously aware of some of your competitors having some issues with the some issues essentially with the FDA on their product. So I guess maybe you could help us understand, what kind of feedback are you getting from FDA on that product and what the biggest hurdles are?
Umang, would you like to take the question on the trajectory and adware?
Yeah, certainly. So I'll speak to the two questions, and then Kedar can answer the question on the margins. So in terms of trajectory, I'd just like to say that, I can't give you any specific numbers, but I do believe that this trajectory should begin to improve quite dramatically from where we are now. I think you're right. We're at about 100 million, and over the calls we've reiterated that we've tried to absorb as much of price erosion from whatever we were trying to bring to the market. And I think as our limited competition opportunities open up, we should be able to show growth over 100 million trajectory. So I think good reference points would be what happens in the next 2 quarters or 3 quarters as these launches come up. And on generic adware, I think at least what we've heard from the FDA is largely around discussions that you have before you initiate a trial. I think those discussions we've been having, and at the same time, I'd also like to add that very often in these trials, you sometimes realize that your pilot studies had some issues, and then you have to go back and redo them, which is what we're hearing some of our competitors having. And it's not the trials are not a slam dunk. It is a lot of effort. I believe that I believe we're about 15 to 18 months away from filing.
Okay, that's helpful. And then, Kedar, if you could help us better understand the U.S. margins.
Yeah. So Manoj, our current scale of business with the current mix of products, we are barely able to cover the R&D and the manufacturing overheads. Without giving any guidance, we would like to believe that the scale-up opportunity presented by the products which will launch in the quarter, next year, the trajectory seems much better. The fully loaded profitability of large peers who are about $1 billion in revenue have upwards of 25-30% of profitability, but we have some way to get there. Having said that, as I said, next year we are quite positive to turn the trajectory upwards.
I'm sorry. So next year you're quite positive that you should see margin improvement.
On the US side, yes.
Yes, and that it seems like that'll largely be a function of output from some of this pipeline.
That's true.
Okay. All right. Thank you for the color, guys.
When we talk to all of you in our May call after the annual close, we'll be better placed to talk about the next year. At that time, whatever I think is more indicative. Okay. Chirag, can we take the next question?
Sure. We have the next question from the line of Kartik Mehta from Deutsche Bank. Please go ahead.
Yeah, hi, I have 2 questions. First, Kedar, on the operating expense, there has been a fairly low increase on that, assuming that R&D cost has also increased. So how do we budget this maybe going ahead? Because on a YOY basis, you guys just mentioned that R&D will increase. X of R&D, OPEX, other expenses, how do we look at that? Sorry.
So Kartik, there is a part of the other expenditure which is fairly variable with sales in various markets. For example, there are data share fees in South Africa, there are sales and marketing spends in other markets. So that part will vary linearly with the revenue growth. The other part, as we have been alluding over the several quarters, we are working on a cost optimization program, and we should continue to see operating leverage going forward.
And on this one itself, how should we assume R&D cost for the next 1 or 2 years, assuming that you will be filing more products and you will have something related to adware or similar products in the respiratory space where you may need to spend more? So very specifically, R&D as a percentage of sales, where should that be?
See, from a capital allocation standpoint, the generics R&D will be largely funded through P&L, and the specialty R&D largely through a balance sheet. That's the philosophy we are looking at. And given that in a particular year, if 2-3 trials get bunched up together, it's fair to say that we will touch about 9% or so. We are currently 7.5%. We don't see the total spend going beyond that, Karthik.
Yeah, and the second one, I think Umang was alluding that there are certain products in the US, or there is some scope for rationalization of the US business. Could you throw some light on this, on that comment on so which products will they be more from Invagen's portfolio or anything, or so what is the benchmark when you guys decide that there's a need to rationalize any product or any therapies that are there in the US?
Yeah. So Karthik, this will be both from the Invagen and India manufactured portfolio. And the idea is to build the US business with very healthy threshold level of profitability, considering the burden on the manufacturing and supply chain infrastructure. So there is no one specific rule, which says whether a product is in or a product is out from the portfolio. But considering a very holistic evaluation, considering some of the burden on the manufacturing infrastructure, considering the past history of supply penalties, etc., I think we will take a holistic call. It's not going to be very large, but we will need something to give us flexibility in the manufacturing and capacity.
So it will not be related to the pricing pressure of that product after you would have received the approval, right? It is a call purely on the supply and the manufacturing side. Is that right?
Okay. I mean, you could actually expect the set of products to be from the older portfolio, not from the recently launched portfolio, if that was your question.
That is the question.
Yeah.
Thank you. This is very helpful. Yeah.
Umang, would you like to add anything on it?
No, I think, Kedar, you've covered it. I think it's a mix of products in the older portfolio where we've seen a fair amount of pricing action and where we don't see margins of threshold and profitability being hit. And it's also a way for us to, juggle our capacity again, because if too many of the old products become volume chuggers for our plants, then we have less ability to bring new products in. So I think it's a mix of these two that will result in this exercise.
Thank you. This is appreciated. Thank you.
Thank you. Before we take the next question, we'd like to inform participants that in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 3 per participant. The next question is from the line of Neha Manpuria from JP Morgan. Please go ahead.
Thanks for taking my question. Just taking the last question forward, given a lot of the larger players in the US are talking about exiting, some of the legacy products, and we are, top 3 in most of our in the products that we sell in the US. Do you think that presents opportunity for us to gain volumes? And is there part of a portfolio where we don't make money or is loss making? Which you think would be the first that will get discontinued if we were to do a portfolio rationalization exercise?
Yeah. Umang, can you take this?
Sure. So I think Neha, I think we will continuously evaluate categories where if we believe that we are the most competitive in the market, then it's quite logical that we will expect others to exit. But if we believe that the market is fairly saturated and the product is unviable, then we would also consider exiting some of those categories. So I think it's a mix of those two. It's a mix of those two decisions, and then we're evaluating each product. And I think the U.S. market today has reached a point where you have to play it comprehensively for value, because you could continue to get a lot of volume out of categories which others are exiting, but that I'm not sure is as financially wise as earlier it used to be. Mm-hmm. Right? You had many options of trying to restructure your value equation on each product, where the volumes, suddenly a player exited and volume requirements went up. I think those flexibilities exist less in today's market.
Understood, sir. So second on, the specialty business, we have mentioned in the presentation that we are in advanced discussion for some, some neurology products for the specialty business. Now, that business obviously requires a lot of upfront cost if and when we decide to, get these products in our portfolio. Do you think that cost will start flowing through our P&L or, in FY19, or would that be a more FY20 type event, based on how your negotiations are going on for these deals?
So FY20 type situation is likely, but at the same time, like Kedar outlined, we don't have the flexibility in our P&L today to pay for extensive R&D on specialty and continue the way we are doing on generic, because we don't have the flexibility of having a very large profit pool business in the US as yet. So I think we will have to, we are trying to use an inorganic approach where we use some of our balance sheet for the specialty route and use our generic and use our P&L for the generic route. So I think that's how we're trying to bifurcate, but we don't have enough flexibility to route everything through the P&L today. But most of the charges on the P&L, if and when they come, will be 2021 period.
Thank you, sir.
Thank you. Next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yeah, Umang, question on Desitab and Pulmicort. When you mention about contracted market share, two things I want to check there. One, are we talking about more than 15% contracted shares there? And secondly, would they start reflecting from next quarter? Or are you talking about very gradual ramp up over that?
Yeah, I mean, I can't give you specific shares, but yes, I would like to believe that both categories should be higher than 15. And I think you should see it. I think by the end of this quarter, the ramp up should begin to show.
So it should start reflecting from March quarter itself?
Yes.
Okay.
Yes.
And do you still maintain guidance of one key approval every quarter, or have you already seen 3 approvals coming and that's what you're referring largely to?
Well, actually, they all came bunched together. We were hoping that they'd be spread out a bit. But yeah, we are still trying to keep our guidance for one limited competition, and obviously now the clock moves forward to end quarter 4 and early quarter 1. So it will start from there, and we're maintaining that.
That's helpful. And you've given a very good split of your top 50 projects, but for the current 79 pending ANDAs that you have, excluding the PEPFAR, can you just talk about something on the complexity or medium complexity of that pipeline? Because we are going to see, really that pipeline coming out in next 2 years. So some guidance there will be useful.
So I don't know if you're providing that as yet, Anubhav, but I think we will take this feedback, what you've given, and maybe when we come back in our May call, we'll try and give you finer details on the pending ANDAs as well. So we will include this information in our press release in the May call, and also talk about this going forward on a routine basis.
Okay, so one question for Kedar sir, one question on the InvaGen write-off. We almost return of $80-90 million so far, which is almost like 15% of the acquisition cost. So are these largely some last time you mentioned about single-digit ANDAs, now perhaps a similar number. So when we acquired, there were 30 ANDAs, and seems like we have return of value for almost 8-9 ANDAs.
Yeah, so I think what we have taken this quarter, Anubhav, is for about 3 ANDAs, and most of what we have taken is in the pipeline category. So I think what we are seeing is the existing business cash flows are fairly protected from the fair value standpoint, and the triggers are basically with respect to adverse regulatory development, which is basically postponement of the launch or a significant drop in the market share. So yeah, to summarize, I think they're very product-specific triggers. The existing commercial business seems to be protected from a deal case standpoint.
I think, Kedar, to add, I think it would be fair to say that as we launch a product that is in the pipeline and we realize that the synergies are not, I mean, the value that was in the balance sheet is not playing out the way we want it to, there will be an impairment evaluation the company will make. So at this point in time, since we are communicating that Sevlamer has pricing gone out of the market, it can be reasonably estimated that a fair amount of the charge is also Sevlamer.
Sure. Thank you.
Thank you. The next question is from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, thanks for the opportunity. Just to try and understand this better, the previous participant. So Gavis this quarter, write-off about amortization of about impairment of about 1.73 billion. But how much of it? When the acquired value is already charged off?
So I think Prakash, probably you referred to Invagen because Gavis is not our acquisition.
Sorry, Invagen.
But sorry.
Too many results going on. Sorry.
Yeah. So your question was the 173 crore net of tax that we have charged. Can you repeat your question, Prakash?
Yeah. So how much? In the past also, I think you took some impairment. So how much of the impairment has already been taken on account of Gavis? On Invagen, sorry.
So in total, the gross impairment that we have taken is about $110 million. Associated with this, there is a release of dev tax at about 39%. So roughly around 60-65 million net of tax have been impaired till now.
Okay, and this can increase given the fact that the fact that Umang just spoke about the couple of products, postponement of launch or reduced opportunity and stuff like that. Or you think at the moment this is it?
So at the moment, given the current projection, this is it. But every quarter, the accounting literature mandates us to do this evaluation of what is the fair value of future cash flows vis-a-vis what we have set up on balance sheet.
Understood. And secondly, on the US again, so you talked about improving market share in few of the products, but Dacogen, I see there are already 6-7 players now. And from a delta perspective and improving outlook in the US, we need more new approvals. So what kind of launches we are talking about for fiscal 19? Any color would help.
Umang, can you take the question?
Yeah, certainly. So I think I'm not sure that Dacogen has 6 players selling into the market today. I think there are 6 approvals, but possibly not as many who are selling into the market. I think we are looking. Look, we filed 30 odd products in the previous year. We were likely to file above 20 in this year, and I think bulk of those will come over the next 2 years. Some of those will be NC-1 products which will come later. So I don't know. I think as a trajectory, as a general guidance to you, I would say we could think about 10 to 15 launches a year.
Okay, starting fiscal 19.
Yes.
Okay. And is there any growth number, aspiration number that we're talking about 19-20 in terms of US, which has been pretty flat, and this is good thing is that this is despite huge price erosion. So a ballpark number would help.
So Prakash, we won't like to guide anything at this stage. Probably you should expect us to comment more in our May call.
Okay. And lastly, one comment you made on the institutional anti-malaria business. So that number had fallen down significantly. I missed that number, but I think the rebidding has happened. So what is the outlook there? Are we into the dispersibles and injectables? If you could help us in terms of what market share we will get in the current bidding.
Umang, would you like to comment?
Yeah, I think there are 2 factors at play. One is just the fact that there are a lot more people who are back into the bidding process. So, if you were to look at, a lot of people had left the bidding process because they had FDA issues in their facilities, etc. Now a lot of them are back in the bidding process. So there's hyper competition. I don't think we're giving details on each bid, but we are also saying that there are challenges in the funding environment because, obviously, it's a lot more difficult now for the global funders to, for the global funding of these type of initiatives to happen because America was a fairly large funder, and the dynamics of that may be changing. So I think there is a general, I would say, a reboot of some of the funding on the funding side, as well as more competition from others who were not allowed to bid earlier due to their FDA issues coming back in on the fray. So I'm not going to say that what we rebid at and whether we won or not, but it's just that it's been a lot more competitive, and that's what we had indicated in our commentary.
And we are in dispersibles and injectables?
I think dispersibles and injectables will not be, are not in the global access. So if your question was for the global access business, this is not, our product range does not these two products. These two products are not in our range.
Okay. Thank you.
Thank you.
Thank you. The next question is from the line of Pratika Jalan from Narnolia Securities. Please go ahead.
Hello.
Yeah.
Yeah, good evening. Thank you for giving me this opportunity. Actually, this quarter we are looking at the South Africa business. It has been very strong for us. Any color that whether there is a sustainable trend that we will see going forward?
If you see the market data for the private market business, we have grown much ahead of the market, and our growth in the private market business for May to December is about 11.1%. Market was around 10. And we would like to believe we will continue on this outperformance.
Okay. And what is the factor that will drive the growth?
So I think our sales force engine as well as the tender business, which is about 35% of the total country revenue, on both sides we continue to see growth, Pratika.
Okay. And can you tell me the capex guidance for financial year 18 and financial year 19?
Okay. So over the years, we have been tapering down our capital expenditure. This year we are likely to end below about 850 to 900 crores. We'll be able to share our thoughts on the next year in our May call, Pratika.
Like till now, what is the capex you have already spent in financial year 18?
Maybe I can come back to you. It's about just short of about 550 crores.
Okay, means you have spent about 750 to 800 crores.
Possibly.
Okay. And can you give me the tax rate guidance for financial year 18 only?
So fiscal 18 full year ADR is likely to be around 25% if you take off the one-offs that we mentioned during the call.
Thank you. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Hi, thanks. Kedar, just to come to the PBT impact for 173 crore impairment charge, which I think you said is net of tax, I should use the same 39%, works out 283 crores. Does it look okay?
That's true. So 283 is the gross impairment, Sameer, and about 90 crores is the release in dev tax. So that's the 174 crore.
Okay, super. The second question is, how big is the beclomethasone in the UK market?
It's a much smaller asset, Sameer. It's about $10 to $15 million in size.
Okay, got it. And Umang, just on your comment on the late advanced stage discussion on the specialty assets, neurology and respiratory. I mean, so you're looking at buying out a phase 3 sort of molecules. Is that what you have in mind?
Well, yeah, we're trying to look at phase 3, late phase 2, and I think we are in that hunt for both respi and neurology. We have some internal programs, but they will take time to get there. So I think we want to accelerate our entry there. And we are clear we're going to do it through our balance sheet, not so much through our own funding, P&L funding.
Okay. And these are necessarily NCEs, and so maybe multiple of $100 million deals sort of a thing.
Yeah, and I think we will do one or two, Sameer, and then after that wait for, we'll have to also create a sales force infrastructure. So I think we're trying to accelerate our journey. It's something that will play out in the next 2 years or so.
Okay. And just one final one on tizanidine patch. You completed phase 1A. So what's the road going forward, and when do you expect NDA submission?
So we will do a phase 2, shortly, and we should be commencing that in about a little bit of time. And then there will be a phase 3. So this is not a very extensive, long trial. As we are seeing it right now, potentially a filing sometime around 21 end.
Thank you. The next question is from the line of Abhishek Sharma from IIFL. Please go ahead.
Yeah, thanks for taking my question. Just on the specialty foray, when you say that it's going to be routed through balance sheet, just wanted to understand what would be your preference. Would it be for capital raising? Would it be debt preference or equity preference?
Right now, I think we are quite flexible. We would like it to be more debt, because our balance sheet has the potential to take on a little bit more debt. I don't think we're talking significantly high amounts at this stage. And I think our balance sheet has the ability to take the leverage there. We may be slightly innovative. We could be thinking of a private equity partner as well if the investments required are fairly large. So, at this stage we are quite flexible, and if it's an asset in the 100, 200, then we can pick it up with our balance sheet strength.
And this capital raising would essentially be linked to the deal that you're doing, or are you looking to create, some gunpowder there that if a deal comes across, then you would do it?
No, I think it will be linked to the deal. I don't think we're going to take debt and wait for the deal to happen, because while we are saying we're looking, these are also highly unpredictable and they're very value-centric deals. So we might bid for an asset, but if the people who want to sell the asset don't think that it's at that value, then you don't get it. So it's a 1-0 game. So it will be linked to final purchases.
Thank you. The next question is from the line of Nitin Agarwal from IDFC Securities. Please go ahead.
Thanks for the question. Kedar, on the overheads, you talked about the operating leverage possibility still being there. We've done a pretty credible job in terms of controlling these costs despite increasing R&D costs over the last 2 years. How should we mentally visualize these SG&A and staff costs X of R&D going forward in terms of a run rate basis?
Yeah, so I think there will be an inflationary impact on a large part of these spends. But yeah, there are opportunities. I think there are specific ideas in manufacturing cost base, there are specific ideas in quality related cost base, repairs and maintenance or administration related costs. I think we do have several of the ideas which have not been fully yet implemented. So without giving you a specific number-based guidance, we will be focused on it in the coming year as well. But as I said, a part of the spends moves pretty linearly with the sales of respective markets, and balance is where the operating leverage will work out.
Okay, thanks. And on that, on the non-US export business, how do we look at that piece now? It's been a relatively less focused piece. There's been a lot of focus on the US. But over a 5-year period, which are the pieces that are focus areas for us on this non-US footprint?
So the non-US export business, Nitin, largely comprises our businesses in Middle East, business in countries like Australia, Myanmar, Vietnam. While many of these countries we continue to be ranked in top 5 and we are growing well, but they are not as high scale to see a reflection in Cipla's overall P&L. And in Middle Eastern market, we have alluded to some of the geopolitical uncertainties. So probably our focus will continue to be on the US market, if that was your question in terms of growth. Structurally, some of these markets may not have a linear growth pattern over the years.
Thanks. And if I can squeeze in last one, Umang, on the domestic market, with government sort of focused on low-cost healthcare and all of these things going forward, how do you foresee the domestic, the regulatory situation, price control-related situation in the domestic market going forward? Are there any valid concerns that one should have on this space going forward?
As a trend, I think 2 trends would happen. I think the healthcare insurance should increase, should allow more families who are not able to afford their own health care to be able to offer care to their families and the near India. So I think there should likely be a volume expansion and healthcare penetration in India becoming deeper. But I also do believe that the government has been quite consistent with what they believe should happen, and that is that they would like to keep price controls in the market. So I think we can expect both trends to happen. I think we can expect possibly more robust volume growth, but we could also expect price control to continue.
Okay, thanks. Best of luck.
Thank you. The next question is from the line of Manushi Shah from Research Delta Advisors. Please go ahead.
Yeah, I wanted to know that how many new products are launched by Cipla in the domestic market in past 6 months?
Manushi, we can come back to you with the exact data.
Okay. And just one more question. Can Pregista launch in US be expected in next 2 years, or is it after that? Just a rough timeline.
Yeah, so at this stage, probably we wouldn't comment on new launches.
Okay. And just one more. The 20 products which you talked about for next year filing. So how many of those will be complex injectables or just normal injectables?
Yeah, I think maybe all these questions, Manushi, the investor relations team will come back to you separately.
Okay, all right. Thank you.
Thank you. Thank you.
Thank you. The next question is from the line of Mehul Sheth from Phillip Capital. Please go ahead.
Yeah, thank you. Thank you for the opportunity. Sir, one question on depreciation side. Even after adjusting this 174 crores of one-time expense that you have taken, its depreciation expenses at around 349 crores. So, is it now a new base that we can consider for going ahead?
Mehul, you need to add actually 285 crore from the amortization depreciation line as the gross value of impairment. There has been an associated release of dev tax in the tax line, which makes it 174 on a net basis.
Net basis. Okay.
What you need to adjust is about 285 in the depreciation line.
Okay, it's including. Okay. And also one question on interest, your interest expenses. So it is like 9 crore in a quarter. So any specific reason means why it's sudden fall?
Yeah, so I think we have repaid some part of our packing credit. That's why it is low. But as a trend, you should probably take an average of 9 months rather than this quarter's number.
Okay. Thank you. That's it from my side. And that will see a very gradual ramp up.
Chirag, can we take last 2 questions, please?
Sure. Due to time constraints, we'll be able to take the last 2 questions. We'll take the next question from the line of Sayan Mukherjee from Nomura. Please go ahead.
Yeah, thanks for taking my question. Just one question. Do you have an update on albuterol MDI file, and can we expect this launch next year?
Yeah, Sayan, our discussions, we know that the FDA is looking at the file. There is, there has been an inspection at the site at which albuterol was to be made. We also believe some clinical trial sites have been inspected. And, we're in communication with the FDA on their responses to our file. So the FDA is actively reviewing it. We hope to hear from them about next steps soon.
Okay. And Umang, just on Advair generic, companies have faced issues with the PK profile. So is it fair to assume that you crossed that hurdle and therefore you're going to start the trials?
Yes, we'd like to believe that on that we've been able to do it. And now it depends on the trial. And having said that, I just want to say that there is a fair amount of risk in these trials as well. Fluticasone is known to be a very, very troublesome molecule. So, we are into the trial period, but yes, I think on the PK side, we believe that we've crossed that hurdle.
Okay, thanks a lot.
Thank you. The next question is from the line of Charul Mehta from Dalal & Broacha. Please go ahead.
Yeah, hi. I wanted to know whether there is any more impairment that has not been taken in this quarter will be taken in the next quarter.
Yeah, Charulata, we spoke about it in the early part of the call. As we launch each product quarter by quarter, we'll have to continue to do this evaluation of carrying value versus fair value.
Okay.
And take appropriate charges.
Yeah. And the second question pertains to improvement in gross margin sequentially. What is the reason for that? Is it mainly because of glucosamide?
So there have been two factors is largely behind the improvement in the mix. This is a recipe season for our prescription business in India, and recipe is relatively higher margin compared to other therapies, so that has helped. What has also helped is the global fund business that has been lower this quarter, and the gross margin of that business is relatively lower compared to others. So these two things have helped apart from the cost and other things that we are working on.
Okay. Okay, fine. And in case of ARVs, are you seeing a reduction in the volumes because of the changing treatment patterns?
Yeah, I mean, yeah. So what we have seen in this quarter is an impact of various environmental issues, some aspects in the funding environment, our own execution matters. So I think collectively all of that has resulted into about 13% decline. We'll have to continuously keep a watch on this business, work on improving the cost base, the economics, and the portfolio in the coming quarters.
Okay, fine. Thank you, and all the best.
Thank you.
Thank you very much. We'll take that as the last question. Now